Hello everyone, and welcome to this deep dive into US GAAP. Today, we are covering FASB ASC 360, the standard that governs property, plant, and equipment. If you are a CPA candidate in the United States, or if you work for a Canadian company with a US subsidiary, this is your rulebook. I am Suresh Periyasamy. As a triple chartered accountant licensed in Canada, the US, and Sri Lanka, I have seen firsthand how easily professionals confuse the US rules with the international rules. Today, we will clear up that confusion. First, let's define our scope. ASC 360 covers tangible assets used in operations that last more than 1 year. This includes your land, your buildings, and your furniture. Look at the example of tech giant Inc. If they buy servers to run their cloud, that is, PPE, under ASC 360. But if they buy a patent or software license, that falls under ASC 350, intangibles. And if they buy chips to sell to customers, that is ASC 330, inventory. Unlike IFRS, US GAAP does not have a separate category for investment property. If you own a building just to rent it out, under US GAAP, it usually stays right here in ASC 360, or is treated similarly to PPE, whereas IFRS would move it to IAS 40. Under GAAP, we stick strictly to historical cost. We capitalize the purchase price, freight, installation, and testing, basically every dollar spent to get the asset ready to work. Critical point, I want to talk about interest capitalization. Under US GAAP, specifically ASC 835-20, if you construct an asset, like building your own warehouse, you must capitalize the interest cost incurred during that construction period. It is not a choice, it is a requirement. This matches IFRS, but it differs from private company rules in Canada, where you can choose to expense it. Let's look at a real-world example. Tesla building a gigafactory. They spend on materials, $500 million, labor, $200 million, and architects, $10 million. All of that is capitalized. It goes to the balance sheet. They also pay $5 million in interest on the construction loan. Under GAAP, that $5 million is added to the cost of the factory. It is not an interest expense on the income statement yet. It will be depreciated over the life of the factory. However, look at the last item, the grand opening party. That $1 million is marketing. It adds no value to the physical building. Therefore, it is expensed immediately. We never capitalize costs that don't add to the physical asset's readiness. Once the asset is on the books, US GAAP is very strict. You must use the cost model only. This is a huge difference from IAS 16. Under IFRS, if your land value triples, you are allowed to revalue it and show that increase in equity. Under US GAAP, revaluation is strictly prohibited. Even if your building is worth 10 times what you paid for it, it stays at historical cost on the balance sheet. US GAAP prioritizes verifiability over current market values. This slide is the most technical part of the presentation and the most tested. US GAAP uses a unique, two-step impairment model for assets held for use. Step 1 is the filter, that is, recoverability test. We compare the book value to the undiscounted cash flows. We ask, will this asset generate enough cash over its entire life to pay back its cost? If the answer is yes, we stop. We record zero impairment, even if the fair value is low. Step 2 is the measurement. Only if Step 1 fails do we move to Step 2. Here, we calculate the loss based on fair value, which is usually discounted. IFRS skips Step 1 entirely. IFRS compares book value directly to recoverable amount. This means US GAAP is much slower to recognize impairments than IFRS. Let's apply that model to see the math. Retail Corp has a failing store with a book value of $2 million. Management estimates the future cash flows, undiscounted, will be $1.8 million. The test would be, that is $1.8 million, less than $2 million. Yes, the asset fails. Step 1. It is not recoverable. For the measurement, we get an appraisal for fair value. The building is worth only $1.5 million. And the result? We will write the asset down to $1.5 million. The loss is $500,000. Notice the gap? We failed the test at $1.8 million. But we wrote it all the way down to $1.5 million. One final rule. Under US GAAP, if the real estate market recovers next year, you cannot reverse this impairment. Once it's written down, it stays down. Unlike IFRS, which allows reversals. What happens when we sell? If management commits to a plan to sell an asset, we reclassify it as held for sale. Once it enters this bucket, two things happen. Depreciation stops. You don't depreciate assets you aren't using. We measure it at the lower of cost OR, fair value less cost to sell. If we sell it later, the difference between the cash received and the book value is our gain or loss. On the financial statements, PPE is presented net of accumulated depreciation. In the notes, transparency is key. You must disclose the depreciation expense for the period, the balances of major classes, examples, land versus machinery, the accumulated depreciation by class, the method used, example, straight line over 30 years. This allows analysts to estimate when you will need to spend cash to replace your fleet. To wrap up, US GAAP is conservative. It prohibits revaluations, it prohibits impairment reversals, and it uses a two-step model that shields companies from temporary market dips. I know the differences between IAS 16 and ASC 360 can be tricky. In our next video, we will do a side-by-side comparison of these two standards to highlight exactly where they diverge. If you need help mastering these topics for your CPA exams or professional practice right now, please reach out. You can contact me via the email address on the screen or through the tutoring link below. Thank you for watching.